Hello, everybody, and welcome to the Like channel. Happy Tuesday, dear viewers. And here we are for another trading session. The US markets are not opened yet. We're going to have to wait a bit longer to see what the initial reaction will be, because yesterday what we saw was the markets initially surged, but then they really sold off into the close, as we are not seeing any resolutions to the conflict in Iran, and that continues to put upward pressure uh, um, um, on energy, right? Oil included, and downward pressure on everything that is not related to energy, and that includes stocks where we are invested. So, guys, today's video is going to be about this. So, I want to tell you exactly what we're going to be looking at past data and see what a surge in energy prices typically means for the stock market, and we're going to look at several years worth of data to see if we can come to any significant conclusions. So, if you are interested in my take on whether or not we're going to see a recession in the next few months or years, please stick around because this video is definitely for you. As far as I'm concerned, guys, I'm definitely not one of those pundits who's been calling for a recession. That's not what I'm doing. And whenever I turn on the news, I can see these pundits just telling you that the recession is gonna happen. A recession is imminent, and they back that up with some data, I mean, to their defense. But the reality is that it reminds me so much of one of Peter Lynch's most famous quotes that I was trying to find for you guys, and you can see right here. So, because I'm sharing my screen right now, you can see what he said. Far more money has been lost by investors preparing for market crashes or trying to anticipate crashes than has been lost in market crashes themselves. And I completely agree with Peter Lynch here. And that's why I don't make any investment decision considering macro aspects, because will there be a recession? Yes, 100%. And this ties nicely into another quote of his, and let me read that to you as well. You get recessions, you have stock market declines. If you don't understand that's going to happen, then you are not ready, and you certainly shouldn't be invested in stocks. As simple as that. Okay. What protects our investments over time is the quality of the businesses that we own, because we believe they're going to be able to come out stronger at the end of the supposed recession, and the fact that we bought it with a big margin of safety. Those are the two ingredients that you need to make very good decisions in the stock market and to achieve great returns over time. And you can see right now all over the news. I'm sharing right now here. This was a piece that was released by CNN yesterday, I think. Right. So this was March 30. Yes, so this was yesterday. And look at this. A recession is guaranteed. But when? Yeah, duh. Of course, a recession is guaranteed. I'm pretty sure there will be recessions, for sure, right? I mean, the same way we have bull markets and we have thriving economies, it makes sense to have a recession or two every couple of years. And as you guys know, we are well overdue for that, because it's been many, many years since the last time we had a significant one. And that was back in 2008. So, yes, so a recession, I agree, is guaranteed. We just don't know when it will happen. But what we do know is, if I go right here to the Fear and Greed Index, you can see that right now we are in extreme fear mode. Okay? I repeat, we are in extreme fear. We are in extreme fear mode. And this typically is the right time to be bargain hunting. And it's interesting, because I read another piece that was an article that was put out also yesterday on Bill Ackman, and he actually says that. So he says, let me see if I can find it here for you. Bill Ackman, I couldn't agree more with what he said. So he says, Bill Ackman says it's one of the best times in a long time to buy quality stocks. I mean, this is a great. I read this, and I definitely recommend you guys read it, because it's so cool. And I couldn't. I mean, I'm really talking his book here. I completely agree with him. I think this, while these recession fears are beginning to spread across the world, we are seeing great companies trading at multi-year valuation levels. That's not to say they cannot become cheaper. Okay, so don't misinterpret me right here, but it definitely sounds, if you are buying a very good quality company, well established, right, then the fact that it's trading at an all time at multi-year lows, it really indicates great opportunities for us long-term investors, and that's what I'm after. Okay, that's exactly what I want to see. So going back to the energy shocks that we typically see that we see every now and then, going back to I think several decades, you will see. Look, this is what I'm showing you guys. Going back all the way to 1970, you can see that every single time we had one of these energy spikes, you can see the gray area coincides with recessions. Okay, hence the title of this chart: surge in energy prices suggests high probability of recession. Okay, this was very good piece of data. In fact, very good report that was put out by Pickett Asset Management. I was looking at it the other day, and it's pretty cool. So right now, look where we are. Okay, so we see one of these sudden spikes, and whether or not we will see a recession remains to be seen. But why do you think this happens, guys? We just need to think a bit. And the reason for that is, if I go and show you right here, a surge in energy prices suggests a high probability of a recession because, of course, it acts as a negative supply shock to the global economy. We certainly don't need to be economists or macro experts to understand the implications of this. Simultaneously increasing inflation and slowing economic activity. Of course, everything is fueled by oil, right? I mean, oil is such an important commodity in today's world that businesses, by and large, just cannot function without it. And what we are seeing is, as long as oil, guys, persists at these levels, for so the longer oil stays at these levels, the higher the odds of a recession. And let's not forget, by the way, that we even prior to the Iran US conflict, the consumer sentiment in the United States was already at multi-decade lows. I repeat, multi-decade lows. It was even lower than what it was back in the 2008-2009 global financial crisis. And now with this spike, I mean, do you think the consumer is really feeling the pain at the gas pump? I mean, I definitely think that is the case. And look what's happening, guys. I mean, I'm not a technical analyst, but you can see that we are already above $100 a share, and that was my fears. So the longer we stay here, the worse things will work out for the economy, and that includes stock investments, at least in the short to medium term. Okay, so hopefully we will see a resolution to this conflict fast, not least because of all the lives that have been all the lives that have been lost, right, ever since this war broke out, which is nasty. But so hopefully there will be a quick resolution to that conflict. But yeah, you can see that right now oil prices are moving inverse to stock prices. So whenever we see a spike in oil, we see selling pressure across stocks, and that makes sense. Right now, stock is pulling back, right? This is the futures. Stock is down a bit more than 0.5%, and the Nasdaq is already up almost 1%. But yesterday, the rally was even more pronounced. But then it really faded throughout the day and gave back all of its gains because oil just rebounded and started upticking. Okay, which is never good. So guys, what exactly are we doing right here? I completely agree with Mr. Bill Ackman. We should unless you are not panicking. The only reason, and I know some of you are panicking because judging by the comments and judging by the messages that you guys send me, and I don't know your personal circumstances, but what I can tell you is this: I can make assumptions, right? The reason you guys are panic is because number one, either you bought using leverage, and leverage is going to kill you over time. I mean, don't use leverage. If you buy a well established company, a high quality company with a huge margin of safety, that gives you enough leverage because once the market prices it back to its intrinsic value, just that, just pricing it back to its real value, that will mean a double or triple for you in a very short period of time. And so you don't need to use leverage if you adopt this framework. And in addition, you can you can be right about the decision. For example, let's assume that you buy a stock using leverage. You can so maybe you are even you are right about that investment decision, and maybe that company is going to go up over time. But in the short term, if that investment goes against you because you are using leverage, you're going to be paying monstrous fees. You're going to be paying monstrous fees because overnight fees will really make a dent on your returns, and that means you will, well, I mean, it will drag your performance over time. All right, and then you may face margin calls. Like some people who have started working with me, they just faced a lot of margin calls in the past. Of course, they end up blowing up their accounts. I mean, yeah, okay. So we don't need that. And the only reason is maybe you are not using leverage, but you are probably feeling a bit lost, and you don't have a framework. So you bought something without fully understanding it. And this is probably the biggest mistake that I see, right? Is many people just take stock picks and then they mirror other people's portfolios. But then that doesn't give you any edge because you don't know about the other person's personal circumstances, you don't know about their preferences, you don't know about their investment time horizons. So there are so many things that come into play. You really have to do some work, guys, because this is your money that we are talking about. And if you are watching this, then of course I'm almost certain that you intend to build wealth sustainably over time, and the only way for you to do that is to actually understand the companies that you own, not just following other guru that you are seeing. And that includes, for example, myself, because I know based on past comments that I even remember a guy who commented one of my PayPal videos, say that he bought a ton of PayPal shares just because I had bought it. And that is insane. And sure enough, what happened? So my cost base is 64. The stock shot up to 80 something before it came crashing down to $40 a share. Now, I still think I'm right in my investment decision. But if you are using leverage, again, this alone will wipe you out. Yeah, or if you are not using leverage, but you have no idea what the thesis is, then you will panic and you will start selling when perhaps you should be adding more to your position. So I hope this is clear. Okay, sorry about the rant. But yeah, so the main takeaway, what I want you guys to take away from this video is, number one, yes, the surge in energy prices typically suggests high probability of recession. That is a fact, right? And you probably already knew that. But it's nice to see data going back to the early 70s and see that this actually coincided with significant recessions. So maybe we will see another one. But the second thing that I want you to take away from today's video is that, number one, the fear and greed index is pointing towards fear, right? So it's in fear mode, the fear and greed index, which means that investors by and large are very fearful, and that can create very good opportunities. And second, think about what Bill Ackman said about this being one of the most attractive, one of the best times in a long time to buy quality stocks. And what does he mean by that, guys? Let's see what he means by that, because I'm just going to give you two examples, and they are actually, well, I mean, Bill Ackman bought these two companies, as you might know. One of them is Amazon. I think he bought Amazon, if I'm not mistaken, and the other one is Meta. But let's just give you Amazon as an example, right? I know some of you are invested in Amazon, or have at least Amazon in your watch list. Certainly, my clients are in that position. If I show you right here, Amazon, okay, typically you can look. This is Amazon. You can look at Amazon's operating income over time because historically operating income is an accurate measure, right? So if I show you right here income statement, you already know probably that the income, the net earnings of the company are a bit bumpy. But if you look in operating income, right? So it's more. Um, in fact, let's have a look at the operating cash flow of the company. Cash flow from operating activities. Yeah, I mean, you can use. Let's just use operating income. Okay, so we will use operating income. And what you can see, guys, right here, if we go to our freeform, you will see the operating. I want to I want to contrast the operating income with the company's price to operating income. Okay, so let's see if I can do that right here. It's taking a while, so bear with me 1 second, because I want you guys to see that on a price to operating income, the company is actually trading at one of its lowest valuation levels ever. All right. So if you understand the company, if you understand the company, and if you understand its mode, this might be an opportunity. As always, don't take this as financial advice. Always do your own due diligence. But price to operating income. Let me show you this. No, they don't. Can I use price? Yeah, let's use price to operating cash flow. We can also do that for sure. Let's do a cash flow, operating cash flow right here. Okay, cool. Why did the other one price right here? Price to operating cash flow. Okay, guys, so look at this. Going back to 2012, since 2012, this is the lowest valuation level that Amazon has traded at. Yeah, on a price to operating cash flow ratio basis. This is staggering. It's not every day that you see Amazon trading at a price to operating cash flow ratio of about 15.46%. Okay, and we are talking about a company, remember, that is projected to grow earnings per share by how much? I don't want to misquote here. So let me see if I can find that information for you. Yeah, so if we go right here to statistics, you can see that analysts are forecasting over 18% earnings per share growth over the next 5 years. And they are projecting revenues to compound at 11.75% per year over the next 5 years, which is staggering. Okay, so this is this is the point that Bill Ackman wants to make, right? And I think he added Amazon to his portfolio, not in the last quarter or so. And yeah, so you can see that the latest price to operating cash flow is around 15.46. And you can see that on average, the company trades at about 26.50. So this definitely means that Amazon can be trading at a discount to its intrinsic value at present. Okay, that said, I'm not. So yeah, I'm keeping it on my radar, but I don't have any intention to pull the trigger yet because I still think the company. I like to go for net income as well. When you use net income, that requires a bigger margin of safety. Okay. So yeah, but that's just me. So for those of you guys who are more risk averse and don't want as big a margin of safety, then this is definitely one of the investments you could consider. Okay, so guys, this is what I planned for today's video. Let me know in the comments below how are you approaching, how are you navigating today's markets. Are you bullish? Do you believe a recession is on the horizon as well? And how are you position yourself for success over the next several years if a recession does come, if a recession does play out over the next few months or years. Okay, so let me know. And as always, guys, if you find this video insightful, please make sure that you smash the like button, because it definitely helps us grow the channel, and that is exactly what we intend to achieve. So guys, thank you so much, and I'll see you in another video.